Hey, what's up, guys? Gonna wait to see if anybody else joins.
Hello.
Hey, what's up, Matthew?
No, what? Just running some tests.
You don't sound too enthused
But I
about it.
got ahead of myself and didn't read all the instructions, and now I'm like, oh man, I have to redo all this. Because you said you'd not to include any like filters like time of day, and I think I
Yeah,
had some filters on there. I'm like, oh man, that's messing
yeah,
up all of my tests.
yeah. I made one exception. That's for the VWAP, but yeah, pretty much it's just testing just the raw pattern. Whereas in the future, whenever we look to build systems off of the initial patterns, that's whenever we'll
Yeah.
look to add filters and everything else like that.
Yeah, the only thing is that when you first initially build a pattern based on a premise and don't add any of those
It's not very good.
filters.
It's not very good.
It's sometimes not very good, but it performs, much better. So then,
Hmm.
like, I would get discouraged because if I was to probably do this without any, uh, restrictions, then I'd be looking at the numbers and saying, okay, this doesn't work, this doesn't work. But I guess you just want to see the fact that we want to identify a pattern and put it into NinjaTrader, right?
Yeah, I mean, being because I know y'all already got Ninja installed and know how to do stuff with
Yeah.
the builder. So this is kind of the next step moving forward is learning how to properly identify patterns and be able to just code them up and test them because that's kind of I mean that's just the first step before anything else.
Right.
And that's and like it's like said in the past. Once you make like a core system for your portfolio, everything else is kind of you're looking for patterns that complement your core systems or try to make up for like the weaknesses that you're currently
Yeah.
encountering within your portfolio. And so having like a already a base of patterns that you could maybe go through and see which ones might benefit your portfolio and build systems off of those, it'd be really beneficial. And that's kind of the whole point of it is just a starting point to kind of extract patterns from and build systems on that.
Yeah.
But I mean, yeah, the results aren't going to be just amazing. They can be pretty good just testing the initial pattern, but
Yeah.
definitely, it just kind of depends how good they can actually be.
Yeah. Yeah, I have to, hold on. Yeah, I have to redo some of them because, yeah, I
If
have.
you already have something built, you can just save a variation of it within the builder, and then just
Yeah, I'll have to do that because I have it, but the ones that worked okay, at least on not on all of the instruments, like
mhm.
metals or grains didn't do well at all, but indices and energies did okay. So like,
Yeah, as long as it does good on like two asset classes,
yeah,
I think it's perfectly fine to add to the list. But if it only does good on indices and nothing else, then kind of iffy.
yeah,
But as long as it's just profitable, on in two asset classes, then it should be fine.
yeah. And I guess at least three or four out of the five profit for a net profit too, right?
Yeah, I would definitely like amongst like if it's profitable on like two asset classes, I would probably want to see it, pretty much profitable on all those individual products of that asset
Okay,
class.
gotcha.
Very unusual in really unusual circumstances will it just be like only profitable on like one index out of the five.
Hmm.
Something might be kind of kind of overfit or kind of up if that's the case.
That's good.
Is my sound like have I got bad background noise coming through?
A little bit,
Okay,
but
I mean,
but
I've got a fan.
only whenever you
Um,
talk though. So it's like whenever you talk, some of it seeps through, but it's fine.
is that better now?
Yeah.
Is that better and stuff? Yeah, okay. I just turn the fan down. Yeah, the internet goes down, so it's just like shit. You just connect to the other one. Like someone's broken something or put a shovel through it somewhere. So whatever. It gets fixed eventually, but you just have to switch. It's the most like shoddy internet you've ever seen.
I can imagine. I mean, you're out in the freaking jungle.
Yeah.
That's kind of how it
So you get
works.
one because you get two competing companies, and one comes from one direction down the road, and the other one comes from the other, and they meet in the middle at your house, and then if something happens in the east, you're fine because nothing's happened in the west. But if you've got power
Crazy.
down, you got both of them are down because the routers don't work and stuff. So it's like whatever. But we've got a dongle and we've got a laptop, so as long as batteries last, I'll still be able to go for it. Dude, it sucks because I just got fiber at home. Like I've got like 900 upload and 900 download, 3 millisecond ping, like best fucking internet,
Yeah,
and
it's like
it's
on point.
for this. So it's like our reference point is like
Yeah, I bet you're missing that.
yeah, and like being able to get food delivery and product delivery and being able to find products that you want and food that you know and are familiar with.
When do you head back again? This is like in the middle
Uh,
of March or something.
we get back in the 22nd of March, I think. Let me check the calendar and shit. But
Yeah, so it's still a minute.
yeah, it's like a month. Um, hey, oh, quick one on the thing, on the project 3.
Mm-hmm.
Do you ever I know this is just going to occur on this project because we don't like Matthew was saying is you don't even know if it's going to be any good without a filter. Like a filter might just make the system like work really well, and then if you don't have it, do you ever find that you can have like a crappy performance system at the very first get go, and by slapping filters on it, it really improves? Or is it more common to see that you've got a good, strong, like decent amount of profitability from the get go, and then you're just gradually improving it? Like, is that more like sort of what you see in
Yeah,
terms of
yeah.
developing
I
systems?
I prefer to see the initial pattern do well because
Yeah,
filters are, like I've said in the past, it's like I mean, like
yeah.
if any filter you might add, it's like a 99% chance it's just overfit.
Okay,
Because like
okay.
what you're saying with the filter is that like if I have this filter on it, all of a sudden this becomes like a more like it's basically better at predicting what's going to happen. Because like I said, when you enter a trade, you're wanting the market to paint you a picture. So a filter
Yeah,
is now saying that okay, this picture has a better chance of being painted now since we're above a threshold or something else. And chances are, if it seems like that filter is actually achieving that, then it's just only because of your current data that you're working with, and probably the moment you add some out of sample data to it, it's not going to hold up.
so it's very rare that there's like magic filters. It's most commonly like it's very common that you have like a good pattern if it's producing well from the get-go, and it's very rare that you're just going to have like a super magic sauce filter that like saves the pattern kind of thing. Is it
Yes.
just, it's just like don't bother with that if it's the case. Like
I mean,
like
every
don't know why
pattern.
you're producing that result, don't go with it.
I would think generally, yes, that's typically the case. You're just not going to actually find a filter that holds up in your in sample and out of sample data. Like I said, once you add a filter, a lot more robustness tests have to be taken in to actually
Yeah.
ensure that it's you know, going to actually make the pattern do better moving forward. With any type of walk forward analysis or out of sample data.
Yeah.
Doesn't mean to not look for one. Dig all you possibly can and try to find filters. Just at the same time, keep that in mind. Like, okay, if you do find something, more than likely it's just overfit. It's just random chance. It's not actually improving the setup. So just right off the bat, assume it's shit, and then
Yeah.
do as many validation and robustness tests as you can to validate that it's actually improving the setup.
Yeah. Okay, cool. Okay.
I just, I have a question about that because, like the filter that I put on my initial things were just the time of day, right? So just the trading hours, so technically between 9 and 5 p.m.
Yeah.
And
So
since
so
and since my pattern is more like based on like volatility, strength, and movement, wouldn't that be kind of like
now,
usually after hours there isn't generally
yeah,
as much volatility, right?
I will say right off the bat, intraday systems time of day is kind of not what I'm talking about, because intraday time of day does in fact work simply because of the reasons that you just stated. I'm talking more like indicator based filters, like volatility and volume, thresholds, trend indicators, all that type of stuff.
So is it okay if I leave my time of days on?
For
Like
the
trading?
for the initial test pattern, no, we're keeping it filter free. The only exception I've given was for if you use the VWAP, because the
Okay.
VWAP actually needs like the first portion of the day to be utilized. But anything else, just to keep the comparisons nice and accurate, because nothing else
Mhm.
is using time of day filtering or anything like that. And
Okay.
everybody that looks at the sheet is going to know right off the bat, like, hey, this system will probably do better with some time of day filtering on
Okay.
it.
Gotcha. Thanks.
Yeah, but yeah, definitely, time of day intraday is an exception and definitely a viable filter.
Did you say that volatility, volume indicators are less reliable? Is that what that I heard you say by any chance, or did I
It's
miss you?
it's really setup dependent. Like,
Okay.
some
It's not
systems
interesting.
it can improve, some, whereas of course most they don't improve. Which I'm talking about just like the basic uses of them. Like, oh, volatility needs to be high to go long, volume needs to be high or low. Just using them in like their general cases, it's generally not going to actually improve any setup the way people think that it will.
Okay. I'm watching the Darwin X thing, and all he's talking about now is just like combining filters, and then like all the different types of filters you can do and test, and the ways you can do the different components and all that sort of stuff. So I just wanted to ask about it. But
Yeah, and once you get into testing and stuff, like I said, I mean, just test it all out. Whenever I have a system and I start looking at filters, that's the first things that I look at. Is the relative volatility and the relative volume, stuff like that. Because sometimes it does improve a setup a lot.
yeah, okay. You just got to test and see, but then you've got to like really be, um, you've really got to look at like why and understand how it's improving it, not just like accepting like, oh, that's a bigger number, so why not just keep it. Like you want to stress it and understand why logically it's actually making it better. and understand the premise of the improvement. Is that correct? Or
Yeah, it definitely helps to understand the premise behind it for sure. All right,
like it's a bad idea to just blindly accept an improvement kind of thing?
yeah,
Generally,
definitely don't do that.
yeah. Okay.
So let's go ahead and get started.
Do you want us to use the chat for questions from this
Yeah,
point on?
yeah, go
Okay.
ahead and use the chat for questions, the live stream channel. And so the title of this video I made different because I wanted to stand out a little bit more. It's trigger versus pattern. And we're going to talk about, the difference and the importance basically. I made some quick diagrams here. 1 second. Okay. So, very important to understand this. Below at the bottom, we have an RSI. Your basic looking RSI. And this is the 50 line, So a very common trigger that people will use with the RSI is whenever RSI crosses above the 50 line, okay? Now that would be just a trigger, period, which, will give decent performance depending on how you use a trigger by itself. But when we're looking at patterns, what we're trying to basically say is that we're going to only use this trigger in a certain market state, okay? Like here, we have a beautiful little uptrend. And the RSI, has a little bit of lag. So this is pretty much what the RSI would look like in this scenario. And so our trigger, RSI crosses above 50, is right here. Okay. Now, if you only took the trigger, it's completely ignoring the type of environment that we're in. So yeah, right now we're in an uptrend. We're in a nice little perfect uptrend. But the market could have easily been in any other state. So what we have to do first is basically look at what is happening before. So we need to quantify what happened before, and then we look for our trigger. So that lets us know what type of market state that we're in. So basically, to enter on these perfect little uptrends, the first thing that we need to have is this nice upward thrust. That's a terrible oval. Nice upward thrust. So you need to quantify this. Say, okay, when this happens, now we look for our trigger. All right. And so let's say the price action before this uptrend looks something like that. So we could easily say that price makes a new high, sets a variable to true, and then we look for a trigger. And the only other thing we need to account for is when we stop looking for the trigger. Okay, so we can say that once we make a new high, we look for a trigger as long as price doesn't break the previous low. Okay. Price makes a new high, then we look for a trigger. Basically, price makes a new high, RSI has to cross below the 50 line, And you can pretty much test this out yourself by just asking yourself, like before the trigger even occurs, can you visualize what market state that we're in? I should be able to tell you, like, hey man, we just made a new high, RSI is crossed below the 50, but we didn't break the previous low. You should be able to visualize in your head exactly what the market looks like. Like yeah, this is a start of a potential big ass uptrend, which is what we're trying to capture. So market makes a new high, RSI fell below the 50 line, price didn't break the previous, we're still above the previous low. And then we look for our trigger. And you can immediately see now that the trigger is very irrelevant. It doesn't really matter what the trigger is. And that's why I've told a lot of people, in some of our first conversations when it comes to algorithmic trading is understanding the irrelevancy of triggers and how they simply don't matter. What matters is the pattern that you're trying to exploit. There's just countless ways you can enter in on this pullback. Countless indicators you could use just to hop in, Now, to further elaborate on this concept, let's look at this exact same trigger, but in different market environments. So now you might be able to understand where I'm getting at with this type of approach. Here we have the market, or the RSI crosses above the 50 line, but a very different market environment. So we would quantify this and then look for our trigger. And once again, it doesn't really matter what the trigger is. This is basically, a very heavy market sell-off. Or in other words, like a price shock, what's commonly called. Like a fundamental price shock, news comes out, crazy drop in price, or whenever the market opens up each day, a lot of times it has a really hard sell-off, and then we're using the RSI crosses above 50 as a trigger. And on the last example here, we have a trading range. Well, first let me go back to the market sell-off. So you would need to quantify the market sell-off, and that would be quantifying the pattern, and then your trigger is what gets you in, okay? And then here, we have a trading range. And then once again, RSI is our trigger, and it crosses above the 50 line. So what you need to do is quantify, hey, we are in a trading range, and the 50 cross is our trigger, and your target is whatever, depending on the pattern that you're trying to exploit. If we're in a trading range, maybe you're trying to, take a trigger and exit at the top of the trading range, or maybe going for a breakout. So this is the difference between a pattern and a trigger. So cool. To all of y'all who currently joined, Gold, Matthew, and Raka, I don't know who else is on YouTube, but do y'all understand that before we move forward? You're quantifying what happens before the trigger, and that's the pattern that you're trying to exploit.
Yeah, that's understandable. It's just to be able to quantify that and put it into into the trader, into the Ninja trader to be able to recognize the pattern. So for example, in your first example, when you talked about that the high, it makes a new high, right, from the previous high. But then, like, my question is, in terms of technicality, like, how do you execute that in NinjaTrader? Because that previous high, how many bars ago? Like, sometimes it's 5 bars ago, sometimes it's 10 bars ago. You know what I mean? And sometimes.
Yes, I perfectly understand.
So
What
that's what
you're
I mean is like,
what you're
okay,
getting at.
how
Now,
how do you tell the system to find that we are at a new high from which high? You know what I mean? From which previous high is it higher?
yes, and it can very much so be done. You know, like most people here, they're very new to trying to figure out how to quantify patterns. And
Yes.
it takes a lot of critical thinking um, to really, just another way to put it, just to really quantify the actual event. Um, and that's why I'm making all these videos. Like we're going to be looking at patterns each day where I identify a pattern and explain how we can quantify it. So it's a slow process, and it takes a lot of critical thinking to try to figure out how to quantify certain things. But that's what the group is here for, and the strategy ideas channel. If you have ideas for certain patterns, and then on the live streams, we will make them together.
Because a lot of times, like I have thoughts of, okay, I see the pattern, or things that are known in the trading community as patterns, right? But they require price, and they require like an RSI. But to be able to put that into word, to in Ninja Trader language, just.
Yeah.
And my biggest thing is like, okay, if I see the pattern, but sometimes that pattern happens over a half an hour period, and sometimes it happens over a period of 10 minutes, and sometimes it happens over a period of 5. And yeah, so how do you capture that pattern when it can happen within those different time span?
Well, you'll get better at it the more you do it, but
So you're saying it's possible.
yes, it's definitely possible. If you, I think what will initially simplify things a little bit for you is just try to narrow down the basic movements of price, just simple swing highs and swing lows, higher highs and lower lows.
Okay.
Like trying to be extra specific, like, oh, this specific pattern happens in 10 minutes versus the other one happens in 5 minutes. Think on like a different scale, like what happened with the swings, like what generally happened with the highs and the lows, because also anything that you produce needs to translate. It needs to be a pattern that will translate over the next 10,000 occurrences. So it needs to be very I guess you could say like non-specific, so to speak.
Right.
Like the first one that I said, just to give a quick example, you could just plot a 50 period high. So it's just a line that looks at the highest period of 50 bars.
Yeah.
And so if you're in any downtrend, then, which is essentially what this first pattern is, it's a reversal pattern. And so the first step in a reversal is price has to make a higher high. So you could just look whenever price when the 50 period high is greater than 1 bar ago, and then you could set a variable to true, and then you could set another variable to what the current 50 period low is, and then look for a trigger as long as the 50 period low isn't taken out. Which if it does get taken out, then you would set the variable that made the new high back to false, and then that would indicate that you never got your trigger, and now we gotta wait for a new high to be made.
Okay. And so that 50 period, you're looking at 50, whatever the time frame you're looking at, that 50 bars ago, right?
Yeah. So the 50 period high is just like saying, whatever the highest point is in the last 50 bars. So whatever time frame you're on.
Okay.
But cool. Let's like I said, we definitely, there's a lot of different ways to break down certain patterns. And we'll continue to do that in the future. Because there's countless ways to do it. And really the sky's the limit as far as how many things you choose to look at when you're trying to quantify something like that. But let me pull up the chart now and talk about two patterns that I kind of want to test out. Let you guys decide. So this chart here is, well, first let me step back a second. Whenever you start trying to find some patterns to quantify, you may have heard me say in the past that I can think of patterns without even looking at a chart, but that's just because I've looked at charts for a long time. So starting out, I think it'll make it a lot easier to just slap some of your favorite indicators on a chart and then try to just find patterns within those indicators, because all it is looking at price in a different way, because indicators is just price. And once again, we're not looking for filters, we're looking for patterns, like market states, like a state of the market that these patterns have potential to quantify at any specific period in time. And so, slap some of your favorite indicators on the chart and then see what you can find. I think that's a great way to just start out and then test it. So some indicators I have on the chart here is a Donchian channel. We got an EMA, and we got the TDI, which is the Trader's Dynamic Index. It basically uses like the RSI with like a Bollinger Bands. So it's like putting the RSI and putting Bollinger Bands around the RSI. It's a pretty cool indicator, one of my faves. And then a Donchian channel I set to 200, and so it just gives us the 200 period high and the 200 period low, and then the middle band is just the mean, and then the EMA, I think this is just a 20 period EMA. So anyways, a cool market state that I like here is whenever price is below the middle band or the mean of the Donchian, and the EMA is greater than the mean. Okay? So this gives us a market state to work with. Okay? Because I can basically say at any point in time, if I had to say, hey, price is below the mean of the Donchian, the EMA is above the mean, you can immediately picture in your head what market state that we're in. And now all we need is a trigger, and we also need to know what will invalidate that market state. And it's pretty obvious here. It's if the EMA crosses below the middle Donchian. Okay? So if price is below the middle Donchian, but the EMA is above, we can look for any type of trigger to go long as the EMA doesn't cross below the middle Donchian. So I think the simplest trigger to use here would just be when price crosses above the EMA. So I can draw a line here. So here price closes beneath the middle Donchian, and then we'd enter long when price crosses above the EMA. And then our exit, for most of the times with these initial patterns, our exit will also just be what invalidates the pattern. Okay, so our exit will be when the EMA crosses beneath the middle Donchian. So it's what invalidates the pattern and what will get us out. So you can see for this trade, it kept on going for quite a while. I'm not sure where we would have gotten out at. It's somewhere way over there. So does anybody have any questions about this pattern? You can see if we would have missed this trade, another trigger, you can see when price closed beneath the middle Donchian here, EMA was above the middle Donchian. So then you look for a close above the EMA, which would have been right there. And then, so that would have been another trigger, basically.
Can we chat here, or should we use the
You can
live
chat
stream
here.
chat?
You can chat
Okay,
here,
cool.
that's fine.
So it's this may be like a very generalized, maybe even a misinterpretation of what you've just said, but it seems like instead of just looking for a trigger and then trying to find a filter, which is like a market state type filter, you're saying screw that, look for market states, and the trigger is irrelevant because there's a million ways that are going to get you in, but you're only going to get in when the market's in a certain state. But it's not just uptrend or downtrend or range. It's like,
yeah. So there's two ways of looking at that, because I basically know where you're going with that. A lot of times, like a filter can be considered a market state, but it depends on the way that you're using it. Like, because all we're trying to trade patterns, like specific patterns, and so for a pattern to occur, something has to happen first, and that's what we're looking at. We're basically quantifying what happens before our trigger occurs. Whereas, if price is just above the 200 EMA, then that's not quantifying an actual movement. Okay, like we're trying to quantify a type of movement. Does that make sense?
Okay. Yeah.
Like if I just said, okay, volatility is above 80%.
That could happen anywhere.
Yeah, that's not quantifying any specific type of price movement. And so that's what we're doing with the market states,
So it's almost like
but wait, so the trigger is crucial to it as well. Because at the same time, if I just said, the EMA is above the middle Donchian, but price is below it, that lets you see what's happening here to a certain extent. Once you find out that occurred and price crossed back above the EMA, now you have a clearer picture in your mind of exactly what occurred. That's why you need. That's why the trigger needs to be what starts the pattern, because it's kind of like a puzzle. It's what happens before the pattern begins. So price is below the Donchian, EMA is above, the middle Donchian, and then price crosses above the EMA like that. Quantifies a whole pattern right there. And then, of course, the exit is just very nonchalant because we just want to catch a giant move. So it's typically just whatever initially would have invalidated that pattern from ever occurring. Because if the trigger would have never came, then that pattern never occurred.
So can we take this like stupidly basic? Is that cool if we do that? Like, because right now we're looking at like an uptrend in the chart, right? Like but then again, it depends on what you define as an uptrend. But it's basically you've got like impulse, a pullback, and then like a long sort of impulse, like another one going off of the chart. So it's like you've got that, and then your next step, like how you came up with this, your next step is like you're looking at the Donchian channels and you're going, okay, they exist around this move, but they're not. There's no interaction with them yet. Like there's no meaning to them. They're in existence. So you're basically creating. It's like
you're basically
when
you're identifying a pattern.
Mm-hmm.
And just accurately quantifying it, and then running a test to see how often it happens.
So you could, okay.
And then if this happens a lot, then it's going to do great. If this is something that simply doesn't happen very often, then results will show that. And that's the whole point of the initial pattern test, and having the spreadsheet. Which patterns are happening a lot, versus not happening.
Okay.
And that's why looking at indicators, slapping some indicators on your chart can make it a lot easier to just right off the bat, try to quantify some things.
Yeah.
So
there's a middle. There's a point where it's like you start off with something, and then because it's like if you start removing stuff, like let's say you remove everything else except for like price crosses above the EMA. At that point it's not a pattern. It's just a trigger.
correct.
If it's below. Like, because the trigger is like that is the trigger, but then the state is almost like if it's below the middle line, that's not a trigger because you're not doing it. It's just a condition. Like if this, then something else kind of thing. Is that the correct way to look at it? It's like if you've just got a trigger, then you've just got a trigger. Like you're just slapping it on the RSI crosses above middle line without any market state. But if you define
the best way, you could pretty much write on paper. You could pretty much say, give me 1 second. Let me actually think, because this might be a good exercise actually for a lot of people.
Yeah.
Let me do. It's not a whole lot to type. Essentially, it's if this happens, then we look for this. That's essentially the formula right there.
Okay.
If this happens, we wait for this. So in pretty much all scenarios, you're going to have a variable that has to be set to true, right? Because that's going to be your state classifier. If price is beneath the middle Donchian and EMA is above it, that's our state. That's our initial state. So sets our variable to true. Now, if price crosses above the EMA, as long as the EMA never crossed beneath the middle Donchian, that creates a pattern. So the initial state doesn't create a pattern; it just creates a state, right? It just creates it lets us see what's happening right now. Like right now, the market is below the middle Donchian, and the EMA is above it. So there's no pattern happening there. The trigger being activated is what then activates the pattern. And that lets us see, a 1 and a 2 basically, instead of just a 1.
I think the important thing here is the trigger is what completes the pattern, because you could have a trigger that's
Yes.
just like
Exactly.
whatever.
Exactly.
The
trigger, that's why I say the trigger is what starts the pattern.
Okay.
See what I mean? The
Yeah,
trigger.
and the result is it either works or doesn't, like down the line. So you've got state, and then you've got a trigger, and then it's wait and see if it worked. Like if it plays out how you think it will. It's coming. It's helping. Like it really is helping.
Now once you
yeah.
once you add an exit, then
That's the
then that's like, let's say our exit was, price. If you're looking at the chart still, let's say our exit is price, makes a new 200 period high, which it did here. Like then, that's basically a 3-step pattern. Like that's very easy to basically quantify. But, like for me, typically I like going for the fat tails. So that's why I'll normally just use, the exit initially for what invalidates the market state, which is, like I said, is EMA cross below the middle Donchian. And then, because I like to know that it's a pattern that historically gives me large moves, like large moves to the upside. Then I can create, some money management rules like we did for the orb. I can maybe take profit or take partial profit at 200 period high, and then maybe add to my position through all types of fancy trade management stuff. That's why the exit is just very nonchalant at first, because that's just it's not really,
Dude,
it's not really what we're trying to figure out.
This is really helping. It's almost like it's almost like you're going for a pattern, and the first two things, the state, which creates the variable, and then the trigger, stays the same. And then you're either going to get pattern A or pattern B. Pattern A is you finish the pattern, complete the pattern in profit, and pattern B is you complete the pattern in a loss. And those are the two things that can change, but it's the same thing that happens over and over again. This is the state, this is the trigger that starts that, and you're either going to exit in a profit or exit in a loss. But the more it's almost like the more loose you leave that, the more it can you can get fat tails, or you have to control the losses and you have to control the profit somehow. But sorry, I'm just rambling here, but this is really helpful.
Yeah.
I think I'm getting it. I'm trying to spout off to see if you're saying no. Well, actually, it's this, but
it's like I'm saying the best way I think of it is in the most simplest terms. Once this happens, we wait for this. Like for example, let's say for the market sell-off example, say you noticed sometimes when the market opens, it drops to the floor and then recovers to the upside. You could just say, okay, if within the first 10 bars of market open, price goes oversold on the RSI, that sets our variable to true. Right? That's the market state, which is market tanks its ass off as soon as we open up. So that's the current market state. Now you look for a trigger for the upside, which can be, like I said, the RSI crosses above the 50 line. So we had our market state, and then we had a trigger. And then the exit is nonchalant. We just hold for a big ass win.
Mm-hmm.
And then I'm trying to think of another example off the top of my head.
Dude, that was a great one.
Yeah, I mean, I think that's the simplest way to kind of think about it. It's just, if this happens, we wait for this. It shouldn't just be we wait for this to occur, because then it's just a trigger. It's once something else happens, then we wait for this. Like, price hasn't made a new high or a new low within 10 minutes. That means we're in a 10-minute range. That's the state. Now we look for a trigger to the upside or the downside if you're trading a breakout or a breakdown. If we want to do like a extended, like price extended from the mean, you can look at the difference between two moving averages. We can say like the difference is like greater than a certain threshold, say like 80. So like moving averages are 80% apart from each other. That's our market state. Now we look for a short to the downside. RSI crosses below 50 line. Simple as that. This happens, and then we look for this. But it needs to be something that quantifies price, because that's what differentiates it from a filter, and quantifies it as a pattern, is it's specifying what price is doing. If the moving average is, if price is above the 20 period moving average, and the 20 and the 50 moving average are more than 80% apart or more than 100% apart, I know exactly what that looks like in my mind. And you should be able to do that with essentially any pattern. If you tell me, price went oversold like crazy within the first 10 minutes of market open, I know exactly what that looks like. And that's exactly why I say that once you know how to do this, you won't even need to look at charts. You'll just think of price actions patterns in your head, and then you just think of what indicators you need to use to quantify that.
Okay. It's going to take some practice.
So what?
It's going to take some practice, because it's like before you started the stream, I was like, what's a pattern? The AMA cross. And then I found out it's not. It's a trigger. So if I wanted to do that's the thing. It's like, if I wanted to do an AMA cross, it's like, well, why? It's like, there's no reason for me to do it unless I believe it's gonna do something specific after it. And then it's like, okay, what is that specific thing? How do you define that? And then it's almost like that's what becomes what matters instead of the EMA cross, because the EMA cross has been crossing and will cross till the sun explodes. It just does. It just crosses. So, but only if you know when you want that to occur in what you want it to look like. That's when it actually matters. Or
exactly. It's just like it's like
the way I think.
You can make all the money in the world using, the 3 period moving averages. Like a trigger, like the 3 period moving average crosses above the 12. That trigger is just as good as any. It all depends on when it all depends on when you use it.
And that's not the 3 EMA crossing above the 12 is not a pattern.
Correct. It's just a trigger.
It's a trigger.
It's something that tells you to get into the market right now. That's all it does.
Yeah.
Essentially, the 3 crossing moving average is potentially quantifying something that the price is going to do. And I say potentially because when it crosses over, the potential exists that the price will continue to move up. Let's say if they cross upwards over each other. And essentially, so what you're saying is that the indicator is telling you that potentially the price will keep going up based on past experience, right? So essentially, the indicator is quantifying a potential in the market.
Well, in this scenario, the 3 crosses above the 12. That's just our trigger that we look for after something else occurs, because that trigger can occur after countless patterns. Like if we look at this chart right now,
Okay. Yeah, like
look,
that could happen on a downward,
say it again.
like the price crossing over. You have what, the 20 period EMA on there?
Yeah, let's
Like
just
the price crossing over the 20 period EMA could happen in a downward movement as well.
let's
But what you're adding onto here is
what
the Traders
happens.
Dynamic Index and the Donchian channel, right?
Yeah, well, what we're adding to it, or what we seek to add to any trigger, is just what happens before it. So let's look at all these occurrences right here where price crosses above the EMA, not below it, just above it to make things more simple.
Yeah.
So as soon as the market opens up, you can see we cross above it right here. That's one cross. That's another cross. That's another cross. That's another cross. Another cross. Cross. It's all over the place. Okay.
Right.
That's if we're just taking the trigger, which has no value. Like I said, that's going to get you in any market state.
Yes.
It's not what we want. But now let's say, okay, I'll take the EMA cross only if X happened before. And so a good one I see here is we can say if price made a new 200 period low within the past 4 bars, then we take the EMA cross. And that occurs right here. That reduces all these signals down to just one.
Yeah.
Because as we can see, price rapidly bounced off the 200 period low and crossed above the moving average within 4 bars. So we're quantifying a pattern. If I say, hey, price just made a new low and crossed above the 20 period moving average within like 4 bars, you can immediately picture that in your head, like a rapid bouncing action.
Essentially, this would be similar to like a divergence strategy where RSI, for example, is under 20, but then the price in, I don't know, let's say in the next 20 bars moves below the price when it crossed under 20, but the RSI was actually higher, like a divergence, right?
Yeah, that case would have been a
So basically what you're describing here is similar. It's a divergence where the price, this is the lowest low prior to 4 bars, but it's going below the 200 moving average, right?
Well, we're not really quantifying a divergence here. All we were trying to specify is when is, a cross above the EMA more reliable.
Right. So in this case, because the price went lower below the 200 4 bars ago, and then we're looking for the signal, which is the cross above the EMA, right?
Correct.
Yeah.
And so that's just specifying the market state before a trigger occurs.
Yeah. Okay.
That's all we're trying to accomplish here with this initial pattern testing. And so back to the initial pattern I told y'all about that I'm curious to test. is, price is beneath the middle Donchian, EMA is above the middle Donchian. That's our market state. And our trigger is the same one we were just talking about when price makes a new 200 period low. It's whenever price crosses above the EMA. So it's a completely different previous market state now, but the exact same trigger. So cool. So we have that one to potentially test today. And we have a different one that I have right here on this chart. So we have a couple different indicators here. We got the DSS, the ADX. We have a smooth ADX and a regular ADX. And so this is a different market state, which once again uses the same trigger. We have our EMA, and our trigger is going to be across above the EMA. But now it's a different market state that we're quantifying. It's whenever price crosses beneath the EMA and then the bar right after crosses above the EMA. So it's essentially what you could call a moving average fake out. It's a moving average fake out play. Super simple pattern. And what would invalidate the pattern from working is if the previous low was knocked out. So if we entered, it would simply be our initial stop would be the previous low here, which would be the 2 period low. And then once again, we just hold for a big move.
Akotic, just real quick on this.
Yeah.
With something as simple as that, like we get a cross below and immediately the next candle is a cross above.
Mm-hmm.
There's one at you see on the ADX, if you read along the ADX where there's towards the end it says 1 minute 14:14. Above the 14, the second last 14, if you go straight up.
What are you trying to look at again? I got two ADXs, the bottom one or the top one?
The middle one.
Okay, the middle one here.
If you read all the writing, it says 1 minute 14:14 at the very end.
Mm-hmm.
The second last 14, if you go straight up from that, it's on the 8 a.m. mark. That's one as well, right? Where the bar crossed below on the main chart, the bar crossed below and then immediately crossed above again.
Correct.
But you're not just slapping this on as like a trigger. You're saying this is something I've identified is what happens generally, not every time, but generally before a move to the upside. And that's the reason for the trigger, correct? Or
well, I don't really know the potential of this trigger is the thing. And it's not just a trigger. Like I said, we're quantifying what happened before the trigger. And because if I just say price crosses above the EMA, then it's just a trigger. But then when I say, price crossed below, then immediately cross back above, then that indicates basically a fake out pattern. So when price breaks beneath a support level and immediately bounces back up because of, rush of buyers, blah, 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 coming in to...
I'm just trying to sort of prod and probe this. If something happens, if it's two things compared to one thing, does that make it
It makes it a pattern. Absolutely.
Really? Two things? Not just one thing, like not an EMA cross, but this and then an EMA cross. That makes it a pattern, or?
Correct.
It's that easy.
Yes. It's something that you're specifying. You're specifying what happens because, like I said, the trigger makes it a pattern. The trigger starts the pattern. What happens before is just what happened before. Like if I said, price crosses below the EMA, well, that's not shit. But then if I say, okay, price has to cross below the EMA and cross back above it within one bar, that's a pattern.
Holy shit! I didn't think it could be like that simple. I thought it had to be like 8 specific things before. Okay, so it can be literally one thing. Like
it's very simple. It's just what happens before something else happens. That makes it a pattern.
So this, you could say another way of this is price has made a new low in the last like, I don't know, like 30 bars or whatever that is. And then it's the next bar has a closed above the EMA. And
Yes,
that could be a valid
that
other way of
that's a
quantifying the
pattern.
same thing.
That's a pattern.
Okay, I'm getting it. This is
Yes.
cool.
That's what I'm saying. Once you get it, you'll be able to do it all day long. The only thing
Yeah,
is when you start getting good at it, you also have to think about what invalidates the pattern, like
mm,
what cancels it out, essentially,
yeah,
because that's going to be your initial stop loss. Like what means okay, this pattern is not going to occur, or it's not going to paint the picture that I wanted it to paint. Like I said, so for this pattern, the pattern is basically think about what the expected outcome is from this pattern. Like what's the purpose behind it? Okay, if price crosses below the EMA and back above within the next bar, then we want a big ass move to the upside. You know,
yeah.
if it
It's
comes
reject.
if it comes back down and breaks the low, then that invalidates the pattern. You know, and it's like with our other pattern. Think about basically, I guess another way to think of it is what invalidates the market state. You know, so with the Donchian example, EMA is above the middle Donchian, price is beneath the middle Donchian. That's our market state. You know, what cancels that market state? Like, what invalidates that market state? It's when the EMA crosses below the middle Donchian, right? Because now that market state no longer exists. Correct? It's the
So this is
it's
the same thing
it's
as before, just two conditions or two specific things before the trigger instead of one.
I see what you're saying.
Or am I looking at it wrong?
But I mean, you can think of it as two, but I mean, it's using two indicators, yeah, but to classify one thing, it's still one thing.
Because they're combined. You're combining it,
Yeah,
or
it's
you
it's
create a very sort
it
of thing like.
yeah, it's combined to create the state that we want, which is prices below the middle Donchian, EMA is above the middle Donchian. That's our state, and so we want our trigger to occur during that state. Now, if the EMA crosses below the middle Donchian, that state no longer exists. Therefore, we don't look for our trigger. Does that make sense?
It's like telling the system only listen to this and only do what you're trying to do when this green light is on, and I'll tell you specifically what makes the green light go on, or when the green light's on. So the green light is prices below the midline of the Donchian thing, but then the EMA is above it. That's when you're allowed to take the EMA cross
Let me.
only on
I've,
conditions.
I've thought a way. I think a way to illustrate it that will really clear things up. Let me.
Sorry, I'll get in the chat here, guys.
Oh no, it's fine. So let me look at this. Let me get this away. Let's make a new one. So this yellow line is the EMA. Black line is the Donchian. This is what our pattern looks like. This I'm drawing price right now. Okay. This is our trigger when price crosses above the EMA. This is our picture. Okay? This is the pattern. The pattern starts at the trigger. This whole picture right here. But it only exists once the trigger occurs. What I mean by that is let me draw this one. Let me draw the same thing over here now. Okay. at this point in time, right here, this pattern has not occurred. Do you understand now?
But the thing's still ready to trade if
Correct.
it does.
So you're looking at what has to happen now to make this pattern occur, which means that this EMA has to stay above the Donchian, and price has to come back up and cross above it to make this pattern occur. That's why I'm saying we're looking at what happens before the trigger occurs to make the pattern come true. Because if price keeps on going down and the EMA crosses beneath the Donchian, now it is impossible for this pattern to come true. That's why you have to know what invalidates the possibility of your pattern, and that's what's going to be sets your variable back to false.
So it's almost like an analogy for it is like, this is what makes, like, the gun's trying to fire all the time. Every time there's an EMA cross, the gun's trying to fire, but the only thing that will allow it to is the safety getting changed. And the safety is what happens, what we're defining when we want that to happen. And we only know, like, we can say what we want to. We have to define what we want to happen as what happens before the move. Like, you can't say, I want this. This is what I want to happen at the end of the move, because then the move's over. Like, there's no logical sense in that. So it's the beginning of the move. You're looking for, like, okay, when, like, the EMA is always trying to fire. When do I want to let it do that? When's the best time to let it fire, basically?
Yeah. I mean, it goes with any trigger, oftentimes the trigger is just what starts the pattern. It's what makes the pattern come true. Because, like, if I erase this right here, up to the actual point of the trigger. So this is the trigger right here. This is the pattern that we have quantified. EMA stays above the Donchian, while price goes beneath the Donchian and crosses back above the EMA. That is the pattern we have quantified. We quantified it because we basically want to see, if when this occurs, we get large moves. When this pattern occurs, do we get, big moves more often than it just falling back down, and stopping us out?
Do you come up with patterns like this and look for big moves? Like, are you doing this pattern in the expectation that you're going to capture the big moves that you've identified, or do you just look for random ass patterns and then hope there's big moves? Like, I guess the latter doesn't really make sense, like why you would do that. But
yeah, that's why I said in the start of in the project 3 help,
mm-hmm.
First note is look at an intraday chart and look for huge moves that occurred.
Yeah.
Then it says look before the big move happened and seek to quantify whatever occurred before the big move. Then it says your trigger should be what starts the pattern, and your initial stop should be what invalidates it.
Yeah, because it doesn't make any sense to try and quantify a move at the end, a pattern at the end of a move. Like, that just doesn't make any sense. So, yeah, stupid question. Sorry.
Oh, no,
it's just this is like really different way of thinking about this, and it's.
I think once you get to it, and like I said, thinking about it in the most simplest terms, it's just, you have a trigger. and you're just looking at what happens before the trigger occurs. What type of market environment, what kind of market state do you want to see before you take a trigger? Like, let's say you were going to take, the 3-period moving average crosses above the 12. So that's going to be your trigger. And let's say you like trading the freaking daily chart on stocks, okay? And your market state you want is, whenever GDP results are just terrible, right? So GDP is like terrible, and then you go to the charts and look for a 3-period moving average to cross above the 12. And then that's your trigger. You're only looking for that trigger whenever your market state is what you want. You see what I'm saying? So the trigger, the trigger doesn't matter. It's the market state you're quantifying before you take that trigger. Does that make sense?
Yeah, makes total sense.
Sweet. So let's go ahead. So y'all have seen, whoopsie. Okay. So you've seen the, we got this pattern, and we got the moving average fake out pattern. Which one do y'all want to go ahead, test, and add to the sheet real quick? We'll let Rocket decide to make sure he's still paying attention. It's a test.
Oh, is there?
Hard question. We got the EMA Donchian trend continuation, and we got the moving average fake outs. Both are trend continuation, trend following patterns. Moving average fake out. All right. So this pattern right here. Yeah, it's pretty appealing because of how simplistic it is. It's very, so let's go to new strategy, and let's call it MA fake out. Let's go to conditions. Let me use my brain for just a quick second. Pretty sure a very easy way to do this is if we say EMA. Bet you would never thought we could do it like this. EMA, where is the EMA? What am I thinking? Not the EMA. Price close crosses above the EMA. I'm going to plot it. Then our other condition is price close less than the EMA. One bar ago. Simple as that. Enter long. Now, whenever we enter long, like I said, our initial stop needs to be this previous low. So the way we're going to do that, there's actually two ways we can do it. I'm going to do it with a variable. So we're just going to call this stop price. It's going to be a double. We're going to go here and say that the current market position equals long. So this is going to happen the same time we enter long. Actually, I should be able to put it on the stop. Let me try to do like this. This might not work. But it's supposed to work like this, but sometimes the way the builder is doesn't do right. So at the point of taking a long entry, I'm going to set our stop price to the low, the 2-period low. Stop price, 2-period low. Then we're going to check that we're long. And then say exit long position by a stop order, putting it as a stop price. So we're long. That's our stop price. And now we have an exit. Min 2. Yeah, so the minimum indicator, which is MIN, stands for minimum. It just gives us the minimum of price, whichever one you choose, because I actually forgot to choose low. So we're going to do the minimum low. Yeah, it's an actual indicator. The minimum low, which is the 2-period low. It just literally just plots a line, the lowest. Yeah, you can have you got low and max, whichever one you want. So we're long, we plop our stop price, 2-period low. And now our goal is to capture a large move. And it's kind of a couple ways we could do it. Let me think. I think what we'll do as an exit is price crosses beneath the EMA with a catch. So we're going to say that because our exit for a loss needs to be our stop, right? That's our exit for a loss. Our exit for a win will be below the EMA. So unrealized P&L is greater than 0. And then we're going to do price close crosses below the EMA. Exit long position, and let's make our EMA as a parameter. Well, yeah, the invalidation is if price breaks that initial 2-period low, but that doesn't really help us with, how we're going to ride for a big win. Right, sometimes it can be both, but in this scenario, it's not the case. So let's set our period as the EMA, and then make sure everything's working. That stop price might not do what I want it to. sometimes it acts up. I gotta put it on a different set.
So right now, what you're saying is like your variable to look for a trigger is if you price your variable to look for a trigger is price if price closes below the EMA, and the actual trigger is if it closes on the next bar only, or
Correct.
is the pattern that is correct? Okay.
Mm-hmm.
And then the initial stop is the low, but there's no like way to there's no like technically there's no way to exit for a profit right now. There's just nothing that tells it to exit. So and the only invalidation of the pattern any invalidation of the pattern results in a loss because it was just going to like hit the low or hit the stop. Is that
Yeah.
correct? Or
Yeah.
okay. So
That's
there's
right.
nothing that tells the system to get out, and now you're creating just a completely separate type of exit that is just hoping to ride like winners sort of thing.
Yeah, which we can just use the lows. We can put like a 20 period low, but in this case, I just use the EMA. So if price crosses beneath the EMA and we're in the money, go ahead and exit. And that should do the trick, but we're going to try out using like a 20 period low as well. First, you guys got to make sure the stop price is working correctly.
Dude, thank you so much for doing this. Like I had no idea. Like
Thank you,
I
man.
just thought triggers. Like that's yeah. Like
I'm glad. I'm glad you're
it's,
catching
it's
on
putting
some.
loads of stuff together. It's putting loads of stuff like it's making things like fit together and putting stuff into place kind of thing. So thank you.
For sure, man. Let's finally get some tests going. We'll just do it for December. What was this called? MA fake out. We're just going to do a 10 to 100. And see if it is working correctly. Looks like it is not. Let me see what's going on. Cross above EMA. If close was less than EMA, one bar ago. Might have given us that because nothing was profitable. Let's run it again. Let's see. Nope. It should be working. Press close.
What was the chart that you originally saw the pattern on? Can you just test on that one product and because you've seen it?
Well, I mean, I think it's just some logic I'm messing up here.
Oh.
Gotta think about for a second.
Okay.
Close, crosses above EMA. We'll just remove that other condition to make sure that's what's causing it. And it is let's see. It's really not making much sense. It's very simple. Close was less than the EMA 1 bar ago. I mean, does it need to be 2? So I've done fake out patterns in the past, and I've never had any issues with them. Now using a 2. Let's see. Seems to be working now, but I don't understand why I had to put 2 bars. I guess it's counting the current bar, but whatever. It's working now, so let's go back to the optimization real quick. Let's do 10 to 100. I gotta actually go pick up my wife here in a few minutes. We're gonna find out what time period does best for the indexes, and then it's the same process for the other asset classes. So we're going to go to optimization, 21 through 22, aggregate the results, maximum net profits, and we're going to run through the accepted time frames. So let's start off with the 60. Pretty decently low drawdowns. Let's look for an occurrence right quick. Oh, didn't specify. Yeah, there's one crucial thing we gotta look at. That's why I wasn't doing what I thought it was. Okay, so we got to quantify this a different way. We have to say if price crosses above the EMA, however, price was above the EMA 3 bars ago, because this indicates that price has to be above the EMA, cross below it for only 1 bar, and then cross back above it. So it might sound kind of confusing.
No, it makes sense. I get that.
Okay. So cross above, then we're going to say price close is greater than the EMA 3 bars ago. And that should be correct.
So this is another set that you just added, or?
No, there wasn't a null set. It was just a slight tweak, basically.
Okay.
It might need to be 2 bars ago. I think it's 3 bars ago. I'm not sure if it's counting the current bar or not.
Yeah.
Let's see. Okay, like you see here, price close beneath, then cross back above. When this happens, it looks to make sure it looks 3 bars ago. So 1, 2, 3. Make sure that we were above it, and that we crossed below and back above. So it is a should be an accurate fake out. Look for a different one. The 60-minute chart. The 60-minute chart's kind of weird. Let's look at the 30-minute.
Yeah.
So we actually get some more bars. So here it's buying on a cross, and I do not know why.
I saw it do that on the 60 before, but I didn't.
Let me see.
Yeah.
So close is greater than the EMA 3 bars ago. Oops, that's my phone. I don't see in what universe the close is greater than the EMA 3 bars ago here.
Your logic made like perfect sense when you were describing what you were doing initially when you first started building it.
Yeah, I'm trying. Like I said, I've worked with fake outs before. I don't know why this is causing such an issue. I mean, the condition here is very clear. Close is greater than the EMA 3 bars ago. That is not the case on the chart here.
Maybe create a variable out of it, or
Give me 1 second. I have to take this call. Now I gotta go pick up my wife, so I'm gonna have to cut this session short. But once I come back, I'll look more closely and see what might be causing this. Because this is just, this is an example of the issues that you might encounter in the future. Things that, just don't freaking make sense trying to figure something out. But alright guys, cool session though. The bulk of the information was, the most important part anyways. Alright, I'll be back in a few. I'll also be in the chat once I get back and figure out what's up with this pattern. Alright guys, I'll catch you later.